And joining me now in the studio via Skype is certified financial planner, Mr. Matt Frankel. Matt, how's it going?
Great. How are you guys?
Doing very well. You have a good weekend down there in hopefully sunny South Carolina?
It was nice and warm over the weekend. It's cold now, but at least we had a couple of nice days.
Did you guys have a school delay today?
No, it's not that cold.
You see, we had a school delay today. It was chilly. We had some snow last night, some ice. I guess they just, want to rather be safe than sorry. Up here in Fairfax County is a huge county, so it's a lot of kids to account for.
It's in the 40s here, which we think is cold.
Yeah. Having grown up in South Carolina, I can vouch for that. I co-sign. Hey, listen, let's get this started this week. We want to talk about the big news that came out last week in the world of banking. There is a big merger that's going to be taking place here. BB&T is going to be acquiring SunTrust. That is a deal. They're going to be buying SunTrust for $28.2 billion. It's going to create the country's sixth largest bank after all is said and done. Now, Matt, you've had a chance to go through the mechanics of this deal, the implications. Tell us a little bit about your thoughts on this announcement.
Well, for the most part, I think it's definitely a good move. Now, take this with a grain of salt, because I am always suspicious when companies justify mergers with the term synergies. As in, this is going to create over $1 billion of annual cost saving after this merger is completed, which is exactly what we're hearing here. But in this case, I think it might actually be true. The main reason, BB&T and SunTrust are both generally Southeast-based bank companies. So there's a lot of overlap between their branch networks. So let's say if one town has a BB&T and a SunTrust branch right next to each other, they could consolidate that into one and actually save a good bit of money. So there is substantial cost saving that should be realized here. The other thing, they're moving their headquarters to Charlotte. Right now, one's in Winston-Salem and one's in Atlanta. I can't remember which is which off the top of my head. But they're moving to Charlotte, which is a big banking hub. Bank of America is based there. Wells Fargo's East Coast operations are pretty much based there. So there's a huge talent pool of just great banking talent there.
Yeah.
And it's just I love the move to Charlotte. And this should give them, not only are they going to be the sixth largest bank in America, but this should make them a dominant force in the Southeast. I'd say about half of my friends down here bank with either BB&T or SunTrust. So now this will kind of combine their forces and just give them a really good market share in their core area. On the other hand, there are some downsides. You mentioned this is going to be the sixth largest bank. Combined, they're going to have about $440 billion in assets. That puts them over. That puts them over the key $250 billion mark to become a systemically important financial institution, or SIFI. The bigger you are in banking, the tighter you're regulated. Not as big of a concern right now, given the current administration. But after 2020, if the other party gets in power, they might crack down on banking regulations, and they're not going after the small ones.
Yep.
So that's my biggest concern about the deal, is that this kind of could increase regulatory pressure on them. I think it'll be more than offset by the cost saving that I just mentioned and just kind of the market share advantage. But definitely a good move. It's nice to see some mergers happening in the banking world again. We've had a ton in the other sectors, but not much in banking lately.
For sure. And I mean, speaking of mergers, as the interview with Ameris' CEO there, Dennis Zember, noted, and we talked about on the show here briefly a time ago, is this acquisition with Ameris Bancorp and Fidelity, which, let's be clear, that's a tiny deal, right? That's bringing together essentially a $1.5 billion market cap bank with a $750 million market cap bank. They're going to have total assets somewhere in the neighborhood of $17 billion. So that's apples and oranges. But I want to go back to something that Dennis was talking about in our interview, because I feel like this was perfect timing, having his interview lining up with the news on this merger, because we get an understanding of the challenges and opportunities for both organizations there. Dennis said in that interview that the deal with Fidelity gives them really the opportunity to drive an identity as a real alternative in the super regionals sector in big markets like Atlanta, Orlando, Jacksonville, Charleston, I'm sure North Carolina will come into play there as well. But we talk about scale and how this is going to create this BB&T and SunTrust deal is going to create the sixth largest bank. And I mean, Dennis made the point there that just being big these days in the banking industry isn't enough. And I mean, it comes down to not only footprint, but he feels like their advantage at Ameris, that attitude and willingness to fight for the business they want. He feels like they're going to be able to surprise some people because of that culture they have with the company. And perhaps the advantage there in being a bit smaller and being a bit more nimble and maybe not necessarily on regulators' radar like these bigger banks are going to be.
Yeah, definitely. It's not always great to be big, especially in a heavily regulated industry. Banking being one of probably the most heavily regulated industry in the world.
Understandably, I mean.
Sure. But especially the ones at the top. I mean, you've seen how much Wells Fargo's in the news, and it's not. And I mean, there have been small banks that have, acted just as badly as Wells Fargo, but you don't hear about them because they're not as scrutinized and as in the spotlight. So this is definitely going to put them in the spotlight. I'm curious as to what the new name's going to be.
Okay,
thoughts on that?
You just jumped in it because we were just talking about that before taping as Chris and Abby were leaving the studio from taping today's Market Foolery. We started kicking around some ideas because you got to figure that the nature of this deal, you feel like probably they just brand everything to BB&T, right? I mean, combining those two names is going to probably be pretty difficult. My observation, SunTrust sounds too much like a soda, right? And if you try to combine the two, I mean, maybe the best case scenario, you get something like Sunny B. I don't know. But all I'm saying is I think it's probably easiest to go with one or the other as opposed to making some newfangled name that no one has any real understanding of from a brand perspective, right?
Yeah, that could be actually one of the potential risks of the deal is that no one's going to know what this brand is that they're going to create. Because they've already said they're not going to keep either of the names. They're going to go with something new.
Oh, okay. So it definitely is going to be either one. Well, hey, everybody, come bank with Sunny B. We've got a great offer for you there on the interest rates. That will make you smile with our day. Put you in a good mood. I don't know,
which
man.
one do you think has better national recognition, BB&T or SunTrust?
I tend to lean towards BB&T. I mean, being from the Southeast, I feel like I've had exposure to both of them. But I mean, I'm sure there are people out there that would say they're more familiar with SunTrust as well. It strikes me that's going to be a big challenge for them coming up with a new name that really resonates with consumers.
I mean, it's been done before and surprised me in the past, but we'll have to see what they come up with.
Yep, we shall see. Okay, Matt, let's jump in real quick to tweets and emails and whatnot. I'm going to start off here with a tweet from a loyal listener, and this is actually in regard to a show we did last week. Not a show that you and I did. I taped the Tuesday episode of Industry Focus with Asit Sharma. We talked about the consumer goods sector and Beyond Meat, an IPO that's coming down the pike here soon. And Warren had just chimed in. He said, Industry Focus is officially my favorite podcast series. They have the best hosts, taking some deep dives into business trends, keeping listeners a step ahead of Wall Street. Warren, thank you so much for those kind words. We really enjoy what we do. Glad it's helpful. Always happy to help. You know where we are. Okay, Matt, first question here, and this was a question we got from last week's YouTube Live show that we did. Chris and Andy and I sat in and did this show, and there was a question that was posed from a viewer. And this sounded like it was right up your alley. What do you think about Realty Income, ticker O, for a new investor? Is it a good idea?
Well, it's my single largest stock position.
So you're saying it's a good idea?
So I'm saying it's a good idea, and here's why. If you haven't heard of the stock, like you said, ticker symbol O, Realty Income, it's a real estate investment trust that specializes in freestanding retail properties. Now, a lot of investors are hesitant to get involved with anything involving physical retail. But you shouldn't be in this case, and here's two main reasons why. One, Realty Income focuses on businesses that are not threatened by e-commerce or recessions, really. Think of discount-oriented retailers like warehouse clubs like Costco, Sam's Club, things like that. Also, non-discretionary businesses, things that people need, like pharmacies, gas stations. And then businesses that have a service component, like a movie theater or a restaurant, things that people have to physically go to that don't really have an e-commerce equivalent. So that's number one. Number two is their lease structure. They're on what are called triple net leases, which is a long-term lease structure. Realty Income's typical tenant signs a 15-year lease or more, so minimal turnover. And the triple net lease means that they're responsible for paying property taxes, building insurance, maintenance expenses. It pretty much shifts all of the variable costs of property ownership to the tenant. And rent naturally goes up every year. It's called an escalator. So it's like a perfect business model for consistent, steady income. Realty Income pays a great dividend. It's right around 4% right now. They've increased it over 90 times since it's been listed in 1994 on the NYSE. They pay monthly dividends. They're coming up on their 500th dividend payment consecutive. So it's just like clockwork, very low risk business. Valuation's a little high, but you get what you pay for. And I really don't see their streak of dividend increases ending anytime soon. It's my dividend stock that I plan on holding for, till I retire.
So, I mean, hey, listen, anytime, we are very transparent about our holdings, and we try to make sure people understand that the companies we talk about that we like, a lot of times we own those businesses because we feel that they are good investments. We are not trying to push anybody in any direction where they shouldn't feel comfortable. But Matt, I mean, you are you have a lot of experience in that real estate industry, and I mean, obviously you're going to be helping with a new real estate service here coming up too. So and take that with a grain of salt there too, and put that ticker at the top of my watch list. I don't know that I have any exposure to REITs, but now that I know this is your biggest holding, I think I'm going to have to at least keep it on my radar. But we have one more email here from Carl. Carl asks, can you please talk about the bulge bracket investment banks and why they're so important, what their influence is on the market, and as a small-time investor, what do I need to watch for? And, Matt, I think this is really more a terminology thing than anything else. I mean, it's this bulge bracket investment bank terminology that perhaps he wants a little bit more clarification on, but can you shed any light?
I wasn't actually familiar with that term until you sent me the article, but generally it just means the big investment banks.
Right.
Goldman Sachs and Morgan Stanley qualify based on the definition in the article I was reading. Goldman, as you know, is one of my favorite bank stocks. Morgan Stanley is also one of my favorites, but for different reasons. I, as a rule, don't invest in banks that are not based in America, just because I don't fully understand all the regulations. It's, like I said, a very complex industry. It would take way too much to understand the banking regulations in every single foreign market.
Yeah.
So and I understand the American banking regulations really well. So that's why for my money, I tend to stick with the American investment banks. Out of those, Goldman is my favorite right now. But yeah, I learned a new term.
Yeah, me too, and hopefully our listeners did as well. Okay, before we get into one to watch for the coming week, I do want to remind listeners that we have another Save the Date for you. If you remember last week, we talked about a YouTube live show we were giving a try, and we're going to give it a try again this coming week on this Wednesday, February 13th. We're going to be doing another YouTube live market show where Chris Hill, Ron Gross, and I are going to be talking stocks, and we're going to be taking your questions. So how do you find the show? Well, it's pretty easy, actually. You just go to The Motley Fool's YouTube channel. You can go to youtube.com/The Motley Fool. Hit subscribe, and we can see you on Wednesday, February 13th. Still ironing out the time. It's going to be in the 3 to 3:30 range. But again, just go to that Motley Fool YouTube channel, click subscribe, and then you'll be able to get in touch with us on Wednesday, and hopefully we'll be able to answer a few more questions for listeners, about what's going on in the markets today, earnings season in full gear here. It's a great time to be doing what we do for a living, Matt. All right, jumping into one to watch for the coming week. What's the stock that you've got on your radar, Matt? What's your one you're watching?
Mine is Tanger Factory Outlets, ticker symbol SKT. Since we already talked about Realty Income and the good kind of retail, yeah. I'm going to kind of push that a little bit further. This is another one that I own, not quite to the magnitude that I own Realty Income. Tanger's a great dividend stock, pays about 6.3% right now. And it's also a kind of retail that's not terribly vulnerable to e-commerce. The nature of outlet retail is very experiential. I mean, I don't know about you, but the reason that me and my wife go to the outlets from time to time is to find stuff that we can't find anywhere else.
Sure.
So it's got the experiential component. It's got a discount component, which keeps people physically going to those properties instead of browsing online equivalents. And they released their earnings today. So by the time you're hearing this, their year end will probably be out. Pay attention to their occupancy rate. Pay attention to any concessions they're making to tenants to keep them around. But more importantly, kind of pay attention to their future plans of how they're planning to adjust to the new retail environment. They've been gradually adding more, dining options and other experiential components to their properties to further, insulate them from e-commerce headwinds. But like I said, great dividend payer, 6.3%, good coverage ratio, so that's not in danger anytime soon. And if that one dips, I may just add to my position in that.
Well, there you go. I like outlet shopping. I find really helpful, and I think just as an example of one brand that's done a good job of incorporating the outlet shopping into their app is Under Armour. I mean, a lot of times I'll just open that app and go straight to the outlets section, and you find all of this stuff that they have on sale or closeout or whatever. And I mean, they're not the only ones doing it, but yeah, man, outlet shopping, you can always find some good stuff at some good prices. I'm going to go with a company a lot of folks recognize here, Ellie Mae, ticker ELLI. Earnings are out on Thursday. And really, this one's just interesting to me. Ellie Mae has had a great year thus far. It's up something like 30%. And this is on the tail of kind of a tough 2018 because it kind of got to the point here where the housing market was becoming a little bit tricky. Tighter housing inventory, rising interest rates was all fueling low home affordability. So they were kind of getting dinged on the purchase side and the refinance side. As rates go up, people tend to refinance less. And that all really is what Ellie Mae does with their lending platform. So the language on last quarter's call wasn't all that exciting. I mean, they were kind of dull, a little down in the dumps maybe, but I'm going to be interested to see how they feel about things going into this call and the rest of the year, especially because we've heard talk about even potentially rates coming back down a little bit. A lot of people out there projecting that the Fed's not going to do anything else to rates for the rest of the year. Who knows? But I mean, it's just going to be interesting to me to see how their attitude is on the call. But either way, still one I like, still own shares myself. And speaking of one to watch and shares we own ourselves, Matt, you bought into my one to watch from last week, didn't you?
I did. I bought Markel right after not right after the earnings, but shortly after when it dipped just over $1,000. I got a couple more shares, and I was very excited. I was glad Jason put that on my radar last week.
Well, I mean, I think you and I feel the same way about that company, so I'm glad you're able to add a few more shares to your portfolio. Matt, listen, it's been great talking to you. Appreciate you joining this week.
Always good to be here.
All right. And folks, as always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. Today's show is produced by Dan the Man Boyd. We're out there wishing our guy, Austin Morgan, hoping he's feeling better there. He had surgery last week on his shoulder, I think there, Austin. Hoping you're resting and recovering. For Matt Frankel, for Dennis Zember of Ameris Bank Corp, I'm Jason Moser. Thanks for listening, and we'll see you next week.